Okay, good morning. So thanks for your patience. Sorry that we're late. We thought we were ready. We came here perfect time, and then we ran into some issues. But we're going to be with you for the next hour or so. I'll go ahead and introduce the panel, and then I'll go ahead with how we're going to roll this morning. So I'm Laura Best. I'm a real estate broker with Berkshire Hathaway. I'm based out of the Oak Park office. But we do have a national and a global presence, and I'm licensed in Illinois. But Oak Park, it's my home office. And then we have Jody.
Hi, my name is Jody Garrett. I'm with Prosperity Home Mortgage based in Oak Park, Illinois. Same office as Laura. And I've been originating loans here in Illinois and Wisconsin, Colorado, all over the country for years now. Previously, I was a professional baseball player for the Cubs. So if you aren't paying attention now, let's pay attention. You got me now, okay? And I'm going to swing it over to Jeffrey. Swing it over to Jeffrey. Got it?
I love it.
I love try that.
Good afternoon. I'm Jeffrey Hines. I'm the managing principal of Jeffrey Hines State Farm Insurance. We're here at 312 Madison. We're licensed in Illinois, Indiana, Maryland, Minnesota, Wisconsin, and Tennessee. We'd love to help you out with any of your insurance needs. And then I'll pass it over to Chris.
Hi, good morning, everyone. My name is Christopher Lafrano. I'm an attorney. My office is in Oak Park. I do a lot of real estate closings in Oak Park, but I also travel throughout the Chicagoland area, Cook County, DuPage County, and pretty much, the surrounding areas within Illinois. So it's nice to be here today, and we hope that you enjoy the presentation.
Okay, all right, thanks team. Next slide, please. So before we get started, I will say there's going to be opportunities for you throughout the presentation to ask questions. I am a fast talker, but pausing every couple of slides will help me slow down and will help you then unmute yourself and ask any question that you might have at that point. You don't need to worry about keeping your questions until the end. I might tell you if an answer to your question will be in a future slide. So don't take offense if I tell you to just wait a little longer for the answer. And we will make sure that we read any questions that come in the chat so that we're not going back and forth. We'll read the chat questions at the end. But just know that you'll have an opportunity to ask questions throughout, okay? All right, so the first slide, of course, as you can see, there's a lot of reasons why people are still renting. A big one, and Christopher and I were just talking about this before we started, is that fourth bullet. People are worrying about how much prices have gone up in the last year or so with the pandemic. Jody, what do you want to say about that?
Well, prices have gone up. It's a supply and demand story. Something to point out on one of the first bullet points, just graduated job history. So that's something that comes up a lot in mortgage. And the idea is you just graduated from college. You may not have a 2-year work history, which mortgage the industry tends to like. But you can come out of graduate school, you can come out of undergraduate school with a job that's got, let's say, a guaranteed salary. And if it's in line with the industry, if it's in line with what you studied in college, for example, if you went to college for, I don't know, computer science, and you got a job in IT, then you can get qualified and get a mortgage right out of school. And your job history becomes your school transcripts. We actually collect up school transcripts in place of job history.
Okay. The other ones, pretty self-explanatory, but let's go to the next slide. So again, home values are increasing. They were at an 11% average. That was the rise in 2021. Can you mute yourself because I hear myself? Thank you. They'll continue to rise in 2022. The projection is at almost 6%. So we are in for the continuation of the joyride that we've been having in the market since 2021. Thank you. Yeah, next slide. Perfect timing. Again, interest rates are one reason why it's a good time to buy now, even though we're saying prices have gone up. And yes, it is low inventory, very low supply of homes. As if you are following, the interest rates are historically low. Well, they were more historically low late 2020, some part of 2021. They're inching up, but don't fret. It's still good rates, and Jody can talk to you more about that.
Yeah, absolutely. So it's better to think about interest rates like they're normalizing now, not necessarily going up. So while they are up from the very, very, very bottom, the interest rate environment is still quite good and very historically low. If you look at a 30 or 40-year chart of mortgage rates going back to the early 80s, they peaked in the early 80s at around 19%. And as recently as 2018, they were 5.25%, which wasn't too long ago. We're right in the middle between the very, very bottom and 5%. We're trending right around 4% at the moment, give or take. And the way I think about interest rates and what's been happening now versus what was happening was the government was greatly subsidizing the mortgage market. So it was like, you have a child that you want to go out and have a lemonade stand on the corner, and you say that you want them to sell $10 worth of lemonade, but no matter what, son, I will buy $10 worth of lemonade from you, no matter how much you sell. That was essentially what was happening over the last 18 months. Now, what's happening is the federal government is saying, okay, well, go send $10, but I'm going to only guarantee you 8 out of the $10, and then 6 out of the $10, 4 out of the $10, 2 out of the $10, and now you're on your own. And that's basically what's happening right now. So on the slide we see in front of me, it's just an example of what it's like when mortgage rates rise and the affordability difference. On the slide references a $300,000 mortgage. It's a 30-year fixed. That would be typical. And on the far left of the screen, it's a 3.0% interest rate. On the far right, it's a 4.0% interest rate. And you'll see on the slide that the mortgage payment goes from in the 1260s to in the 1430s, I think. And that's about $160, $170 per month difference on a $300,000 loan. If you want to project downward on a $200,000 loan with a 1-point difference, it's about $100 difference per month. And if you go up to a $400,000 loan, then it's about $210, $215 a month difference in a 1-point swing. So definitely affecting affordability, but still quite a good time to buy. If those rates were higher as they were back in 2018, you'd be having, a much different conversation.
Quick pause for a second. So we have a few monitors here in the room, and right now I see in my screen number 3, 4 reasons to buy. There's a scale, there's a teeter-totter, and I want to make sure that that's the slide you guys can see. Can somebody unmute and tell me what you see on your screens, please?
That's it.
That's what you see? Okay, so you were able to see the graph that Jody spoke to earlier on the prior one. Okay, perfect. Thank you, guys. So any questions thus far? This is your first question break. If it's in the chat, we can't see it until the end. Feel free to unmute, and then we'll do it at the end. Otherwise, feel free to, okay, somebody sees the 4 reasons to buy slide. Perfect. So that's the big number 3 on the left. All right, let's keep going.
Yeah.
So yes, no, you can keep it right there. The 3, the third of the 4th reason to buy is that right now, if you are renting, let's say that your rent is in par with the average Chicago rent of $2,100 a month, and you make that payment 12 months out of the year, you know how to do math. You see how much you're spending in rent every year. And if you were renting at that same rate, again, remember at that same rate, rents are going up also, you're going to be out of pocket almost $76,000. So why not put that in a mortgage? Now, even in the suburbs, you could say, well, I don't pay that much. I don't pay $2,100 a month. The average in the suburbs is about $1,800. That's, that's no small bill. So keep that in mind as one of the reasons why it's good to buy now. Next slide. So I think all of us are going to speak a little bit to this slide because we all have different backgrounds and different ways that we could contribute to the context of this slide. You know, everybody wants to build equity. Everyone wants to be able to have some form of wealth. So one of the top things that comes to my mind is a tax incentive, right? So if you don't own a home yet, or you haven't in the past, maybe you don't know that there's tax advantages to owning a home. And for example, the interest that you pay on your mortgage, as well as the property taxes, those are deductions on when you file your taxes. Jody, Christopher, Jeffrey, anything to add on that?
Sure. You know, I couldn't agree with Laura more. Certainly, there are many tax advantages. There's also advantages, you know, from a personal financial benefit and equity perspective as well. I'm not a financial professional, but I obviously represent a lot of clients, and I've seen a lot of first-time home buyers really start the process of building wealth for their family. They're the first people within their family to buy a home. They're first-time home buyers on their own as well. And that's a great way to kind of start a tradition and a way of improving your not only your individual personal financial situation, but also that of your children in the future, right? Because people that you know, live in a house that they own, and kids that grow up in it are more likely to do that in the future as well. And so, you know, there's just a lot of benefits to buying versus renting. You know, it's implicit, but when you're renting from someone else, you're building that person's equity. And if you're building equity, why don't you do it for yourself? So that's just my own personal opinion on it. I think it's overall a good thing for most people, depending upon your situation, but for most people.
Yeah, and I can comment a little bit too on the personal financial benefits to it. So every year, if you've had a mortgage in the past, you know, every year you'll receive a form 1098 in the mail from your mortgage servicer. And that 1098 is the mortgage interest that you paid. Now, I'm not a tax advisor either, but if I was, I would be saying that amount of mortgage interest, the reason you're getting a 1098 is because when you do your taxes, that is likely to be tax deductible up to $10,000 per year in Illinois. That hasn't always been the case. It was different pre-2017. Tax law changes in 2017 changed that. And so that your mortgage also has to be below $750,000 for that to be qualifiable. So if you're in that privileged position to have a mortgage that size, just keep it around 750 or less if you're trying to get the tax advantage. Again, that's just my own personal opinion. I'm sure a tax advisor would probably confirm that.
You want to add something, and I'll just flip the screen?
Yeah, I think from the insurance perspective, as we think about the things that we want to protect, it's an opportunity for you to start building your legacy. So as you're thinking about these tax advantages and thinking about how do you want to protect the things that you and your family are building, this is also a great way to think about the home purchase as a part of that legacy building. I'll talk to you a little bit later about ways in which you protect that asset, but in terms of building, you know, equity and generational wealth, which is one of our focal points, it is a way for you to do that and eventually pass that wealth on to your family members.
Okay, thank you. Next slide, please. So this is just a very quick overview of how the process is if you do decide to buy a home, which we all hope that you do. Obviously, that's why you're here with us today. It's a very simple process. It might seem overwhelming if you're not getting educated, like from people like us today. But definitely many professionals that will help you along the way. Next chart, please. One big thing to keep in mind is what we call in the real estate world agency relationship, right? So your agent can be representing you as the buyer's agent. If you're selling a home, that could be another agent that represents you as the seller's agent. And a dual agent, it's somebody that it's on your team. If you choose it to be this way, the same agent represents you as a buyer and represents you as the seller. It is legal to do that. It gets very sticky. I always want to make sure that my clients understand how that works, because it's hard to maximize the outcome for both sides in the same transaction. But, and I see Christopher nodding his head. And it is legal in Illinois, but I always want to make sure that my clients understand what a dual agency means. One thing to also know is that if you are buying, you do not pay the commissions of the agents. The seller that puts the property for sale in Illinois, they are in charge of paying a commission to both the agent that sells their house as well as the agent that finds a buyer for their house. So don't fret, you're not gonna have to pay any money at closing to, if you hire me to help you buy your home, because the seller is gonna pay me for that. Okay, next slide, please. So we talked about earlier, you know, it's simple supply and demand, you know, more people to buy and less houses. That means that we are in a seller's market. So Christopher, you know, since you see a lot of these transactions and how tough it's been, what's your take on this and how things have been different and or tougher in the last year or so?
Right. So I'm going to get into the inspection review process in a couple of slides, but as it relates to the marketplace right now, you know, a lot of buyers, when they put in an offer for the home, they're going to do an inspection after the contract's accepted. And as part of that process, they're going to want to negotiate repairs and credits, and they're going to try to get the best deal that they can. Problem is, in this market, the seller, before they accepted the buyer's offer, might have had 3, 5, 10 different offers before them. And so when the time comes in the transaction for the buyer to try to get the best deal that they can, which is their right to do so, the seller is receiving those requests with the knowledge in mind that this is a seller's market. And so it makes it very difficult to negotiate that piece of the deal. Also, because the prices of property in general are increasing so much, the appraisal process, which Jody will get into later in the slideshow, also becomes a challenge, because, you know, one of the requirements when someone's purchasing a home with a loan is that the property has to appraise for at least the purchase price. And if the prices in the market are increasing greater than the appraisers, you know, in their opinion, assign a value to, then that causes other trouble in the home buying process. So every transaction is unique and every transaction is different, but in general, it's becoming more difficult for buyers to both get their offers accepted and, once accepted, to navigate the home buying process, because their leverage has decreased so much because it's such a strong seller's market. Good for sellers, challenging for buyers.
Thank you. So we're going to move into some of the financing things now. I'm going to, what is it? Bat the ball to Jody? Swing it, sorry, for the next couple of slides. But before we do that, feel free to unmute if you have a burning question that you'd like to ask now.
I think we're good.
I think we're good. Take it.
Okay. So one of the first things that you'll want to do, or Laura will want you to do, or what any good agent is going to want for you to do, is to figure out your financing. See if you're financeable right this moment and get pre-approved. So you want to meet with a Prosperity mortgage consultant or any lender that you're out there working with. What you're going to do is you're going to verify income, credit history, and asset information by providing documentation. You're going to establish a comfortable purchase price and a monthly mortgage payment. And you're going to budget, if you need to, for down payment and closing costs. Now, the way I like to think about this, and in a way that's sort of memorable, is loans are done on 4 basic areas of approval. And I remember them as an acronym: CADI, CADI, like Cadillac: credit, assets, debt, and income. CADI. It's really, really simple. And you've got to hit a minimum threshold on all 4 of the categories in order for you to qualify and ultimately get pre-approved. to buy a place. A pre-approval will generate a letter. We'll get into that in a second. But those are the 4 areas: credit, assets, debt, income, caddy. Everybody got it? Cool. Let's move on to the next slide. All right. The pre-approval process itself, there's two main ways that you can get pre-approved. Okay. There's the traditional way, and the documentation is pretty straightforward. It's 1 month of pay stubs. So that for most people, that's 2 pay stubs. For some people, that's 4 pay stubs if you get paid weekly, or 1 if you get paid once a month. 2 years of W-2s, 1099s, or K-1s, whatever your compensation is. W-2 doesn't necessarily mean salary. It doesn't necessarily mean that you're okay. I get a W-2, for example, and I'm not okay because I'm not salary, but I get a W-2. So W-2 doesn't set you free. It really is a little bit more of an involved process. 1099s are if you're self-employed, or if you're a contractor, if you're part of the gig economy, you're getting a 1099 most likely. And a K-1 is when you own part of a company and you're getting a distribution from a company because you're part equity owner, okay? 2 years of 1040s, that's the official form for personal tax returns. And then 2 months of financial statements. So that's the traditional way and the traditional set of docs. Now we have something called Accelerate, XLR and the number 8. And if you know that other company that we'll call Rocket Love and Lending, they have a form of this. We and they are some of the only folks, there's less than 10 in the entire country that have a digital platform to verify digitally income, assets, and employment. So for example, if you're renting and you qualify for Accelerate, you are providing me nothing more than your driver's license in order to buy a place, which is pretty powerful considering documentation for people can be a pain. And it's really a pain if you wait till the last minute and try to move and get those documents. We try to get all those things up front. So Accelerate is something that we've got a really strong privilege, and I like it so much that I get put on training calls for my company to teach other people how to do it. But the reason I'm such a fan of it is because it really limits the number of documents and really enhances the experience that a buyer has with us. You can advance the slide, Chris. Thanks.
Okay, I think this is me now. Thanks, Jody.
Sure.
So obviously you now have your pre-approval process done by Jody, and you are already thinking about how much home you want to buy and how much home you feel comfortable affording. This is when the fun starts now. We're going to meet. We look at an area where you want to live, your must-haves, the priorities. And I say priorities because in a market when there's very little inventory, if you want 10 things in your home, you might have to settle for 6. But it doesn't mean that you're settling in the long run. You can probably get the other 4 items with a little elbow grease and a little equity. So that dream home will be there for you, but I will advise you in how to best get it sooner rather than later. Next slide, please. So the property search is very simple, especially with technology. You know, you get listings from me. I can email them. I can text them. I can airdrop them. I can, whatever you want me to do. There's constant communication back and forth as to whether or not you like those homes or don't like them. We go see some in person, and then we take note as to, what was wrong with that house and how should we refine your search as we continue the home search process. So say that you find a home that you want. Great. Like Christopher said, we might be fighting with 10 other families that want to buy the same house. So we will talk about how to best make an offer. I will pull comps, what we call comps, that stands for the comparable homes in the area. Comps for Oak Park are not going to be comps in Geneva, and they're not going to be comps in, Palos Heights, right? So we make sure that we have the right comps. And we are then going to come up with not only what I think would be the fair market value for you to offer the home, but you also have to be comfortable with that number. You're going to be the one paying the bill. Next slide, please. So once we have the offer and you sign in all the pages you need to sign, which can be done again electronically, we as agents present the offer on your behalf. every offer that is presented to the agent that's representing the seller, it needs to be presented to the seller. People worry about, oh, well, my offer might not be good enough. I will, advise you as to how to make it better, or I will tell you if in fact it's too low. But once I deliver that offer to the agent that represents the seller, they have to present the offer. That's our fiduciary responsibility. And there might be a multiple offer situation. So Christopher, you want to talk about those? No, go back one more.
Sure.
Yeah. You got it.
So in a multiple offer situation, the seller is sitting back and receiving these offers from potential purchasers. And, of course, I represent both buyers and sellers. And so oftentimes I'm brought in early in the process before a seller's accepted an offer to evaluate that offer. And so, what the seller's looking at, of course, is the overall price that the buyer's offering, but also we'll be looking at other aspects of the offer. So, for example, the closing cost credit is something that's factored into the decision by the seller. The type of financing that the buyer's receiving. So, we'll be talking a little bit more about this, but buyers generally, if they're getting a loan, will either be getting a conventional loan or an FHA loan. And so there's different processes and consequences of those options. And so the seller, when evaluating offers, will look at the type of financing. Recently, in this crazy market that we've seen in the past 12 to 18 months, some buyers are submitting offers with an appraisal gap contingency, which basically means the buyer's agreeing to either cover some of the difference between what the price in the contract states versus what the appraised value is. Some particularly risky buyers are waiving their inspection contingency and appraisal contingency. So these are all different factors that a seller will be evaluating when they look at your contract. And so that's something that's unique in this environment, and that's something that an experienced real estate agent can help you kind of navigate.
I think Jody wanted to add
no,
something.
sure.
Yeah.
Sure. Comments. Yeah. Thanks, Christopher. So your offer is your offer. You should trust the people around you. You just heard Christopher talk about contingencies on appraisal, inspection, etc. That may or may not resonate with you at this moment, but this is just a moment to pause and say you need a good team around you in this market, especially, to get your offer accepted. It is a very difficult time, probably one of the toughest times in history, to go it alone, because there's way too many nuances for the offers that you have to make and the strength that it has to project, and your entire team that needs to contribute to the effort. Okay. I'll give you an example. A few hours ago, I was having breakfast with my family, and I got a phone call from a listing agent, and the listing agent was saying, "Hey, my name is so-and-so. I need to ask you about, Mr. and Mrs. Smith, and did you verify income, employment, and assets? Are they non-contingent?" What's called non-contingent, meaning can they buy before they sell anything else that they own? Now I'm sitting there in my jams with some coffee, talking to my kids, but I picked up the phone, and that's the type of market that we are in. And I picked up the phone and I said, "Yes, I remember that these folks, their income, employment, and assets are verified. I remember because their Accelerate, if you can recall that." And I said, not only are they qualified, they're great people. They've got kids. They're great for the block. You'll probably get more listings from this block if you are the one that brings in these buyers, because they're great for the neighborhood. You want these people to double down in Illinois and not leave. These are your buyers. Tell everyone else to scram. And that is what I said. And that is what it takes in this market to get your offer accepted. So your whole team contributes to the effort these days. Jeffrey, do you want to add something?
I just want to add very quickly, this concept of team that we've been talking about is really also important as it relates to the closing process. And we'll get to that at some point, but you've also got to have an insurance professional as part of that to make sure that when you're buying your home, that your home is covered. And at the closing table, that is one of the questions that they're going to ask you. Oftentimes I will get calls in the middle of the night, so to speak, that is, hey, we're closing on a house tomorrow. Can you, write the insurance for it? So again, back to the point earlier, the team is very important, making sure you have the right people around you and making sure that you all understand the process and know who has what part in that process.
Awesome. Can we pause for questions before we move on to the next couple of slides? Okay, let's move. Thank you for forwarding the slide. Okay, so let's talk about the inspection. If you did not waive your home inspection contingency, which I don't recommend, but if that's what you want to do, you could do it. That's one of those things that people are now trying to do to, so to speak, be the best offer, and what that means is that you're buying the house. It doesn't matter if 3 months later something falls apart or your roof collapses. Of course, I'm being pretty dramatic there, but an inspector that will go see the property and spend a couple of hours, if not more, at the home will make sure that it's structurally sound and make sure that there's no cracks in the foundation and make sure that your plumbing works as it should work, etc. You get the idea. So if you are doing the home inspection contingency, that's done in the first 5 days after you go under contract, meaning your offer is accepted. And that's what we call the attorney inspection contingency review process. So Christopher, you want to add?
Yes. So the first 5 days after the offer is accepted by the seller is a critical time period for the real estate attorney, primarily to step into the process and make sure that the contract that was agreed upon between the parties is correct, to suggest and propose some modifications to the contract. During this first 5 day period, I spent a lot of time reviewing the contract, doing due diligence on the property, particularly with respect to the property tax situation. And so what I do is I check the property to make sure that, to look at the assessed value history, to look at the exemptions that are on the property, the most common one being the homeowner exemption, and making sure that the way the taxes are set forth in the contract are a fair way to calculate them at the closing. I also review the real estate disclosures that accompany the sales contract. So the seller is required to disclose defects in the property that they are aware of. And that's an important part to the process, and it's something that the buyer is entitled to receive and to rely upon. That is really the beginning and the end of the obligations, of the obligation that falls on the seller when it comes to selling a home. A lot of buyers, particularly first-time home buyers, are surprised when they do their inspection and the inspection report comes back and we discuss it, and they have a whole list of concerns, some major, which obviously we have to take seriously, and some minor. And we have this conversation, and I try to explain to my clients as best as I can, the seller wants to sell the home for the highest amount and do the least for you. And the seller's not required to provide you with a home that's defect-free. And so as part of the inspection and attorney modification process, both attorneys and both sides in the deal really try to do the best they can to make sure that the buyer and the seller have a transaction that they could at least live with. And so from the buyer's perspective, we may submit requests to the seller to take care of certain repairs or to provide an additional closing cost credit. But it's something, the expectations of the buyer have to be reasonable because the seller only wants to do so much, whereas the buyer wants to get the most from the seller. And so, that's really a very, very important part to the process. And, I can't strongly recommend enough to do a home inspection in any type of transaction, right? So there's transactions that are as is, which means that the buyer is agreeing to take the property as it is without any sort of repairs, versus, most standard contracts that are not as is. And so even in an as is situation, it's still a good idea to do your due diligence and have a professional home inspector come in and look at the roof, the foundation, the plumbing, the electric, et cetera, all of the major things in the home. So this is really the most important part of making sure that you're getting a home that fits your needs, is the first 5 days of the contract.
I think you have the next slide too, maybe a
Sure.
little bit more of, yeah.
Sure, and I mentioned this already, but the attorney review process runs at the same time as the inspection review process. So it's the first 5 days of the contract, and the attorney that you hire is going to look at the contract, propose modifications, and make sure that there's no red flags, so to speak, that need to be addressed. And so even in this market, a lot of buyers are waiving these important contingencies, which can be risky. It can certainly make your offer competitive, but it could also be foolish in the end. So I advise against doing that, even in a tough market.
I think the three of you have the next one too.
Sure.
As we get to the final loan approval process.
So the slide itself is the final of the contingency slide. So again, the last couple slides have been contingencies. So there was an attorney review process, there's an inspection, and then there's a mortgage contingency, which is this slide itself. So take a pause here for a second. Property is, in a traditional sense, is going to be inspected twice, one by a home inspector up front,
Mm-hmm.
and there's your first out-of-pocket expense. And then it gets a second look that's more due to the value of the property relative to the other properties, as well as structural things. And that's from the appraisal, which happens in the middle. And that's the second part of your upfront out-of-pocket costs. You're going to pay twice upfront, and your insurance gets paid at closing, not before. You can pay it before, but it's a pain in the butt. So please just pay it at closing, because it's easier for us to not have to account for it until closing. So the last thing is the mortgage contingency. So on the slide here, you'll see that you're going to stay in contact with your mortgage consultant. Of course, the home value will be determined by an appraiser. And again, that's going to occur in the middle of the process, usually after an inspection, where on the lending side, we don't need that that inspection report. I actually don't want that inspection report. All I want is for the buyer to tell me, yep, good to go. We're probably going to ask for some stuff, but we're probably going to move forward. Or, OMG, this house is terrible underneath. I really doubt it, and I really am not sure about ordering this appraisal, because again, it's $450 minimum usually to have an appraisal. And that appraiser is not our employee. That's a third party. That's an independent contractor. And he or she does not care, whatever their pronoun is, they do not care whether or not your transaction moves forward, okay? So you want to make sure that you want to move forward with some level of confidence, called intent to proceed, if you want to go by the mortgage jargon of it. The appraisal must be equal to or higher than the negotiated purchase price. As Christopher alluded to, occasionally, especially in fast-moving markets, we have appraisals that come in low, okay? And without getting too far down into this rabbit hole, because you can really go pretty far down, when it's lower, there's a couple of different options to deal with it. And you have to have the right team with you in order to expertly negotiate and navigate those paths so that you can maintain your transaction. The final loan approval commitment letter is what we send. In our marketplace, it's not exactly the same thing. We have something that's called clear to close, and that's different than getting a written commitment letter. So a written commitment letter occurs after an initial underwrite. Again, not getting too crazy here and keeping it pretty simple. We can generate a written commitment letter with closing conditions right after the initial underwrite. But in our market here in Northern Illinois, that's not really the standard. We have to be done with the loan. And when I say done, I mean done, where there's no contingencies or conditions left but you're alive for the closing and you haven't lost your job and some other pretty small things. Where we are final approved, and but for an act of God or something unforeseen on income, we're good to go. So that's what the mortgage contingency is, and you'll hear an AKA clear to close. That's going to be the normal parlance that you'll hear in the real estate industry here.
I
So
think
this-
Jeffrey, did you want to? I'm sorry.
No, it's
Jody,
okay. Did you
Do
want
you
to
want to add it
on the
now or
mortgage contingency?
later? You're the insurance portion of it.
Yeah, so I'll jump in very quickly from an insurance perspective. We'll add these slides as we send these out, but a couple of things that you want to think about as you get close to closing. The reason insurance is so important is there's 4 things that we think about. One of the things that we do is it protects you from natural disasters. Many of you guys are aware that we just had snowfall here in Illinois, and in other parts of the country, if you may be watching, there's been all kinds of things that have happened. So it protects you from any natural disasters. The second thing is that it protects you from theft. As we know, people sometimes take things that don't belong to them. And so the insurance is important because it helps to protect you from the theft that could happen there. The third thing is protection from lawsuits. We are in a litigious society, so people often think about, let me sue you in the event something happens. I come to your house, I fall down the steps, I now, sue you for, $1 million because my career is now over. And so it's a way to protect yourself from lawsuits in the event that happens. If you have a caregiver that comes to your house, a nanny, the person that cleans your house, any of those things, it offers you a sense of protection there. And then lastly, as I said at the beginning, it is a mortgage requirement. The folks in the room here, unless you're able to stroke out a check for, $750,000 for the house, then you're going to be required in the closing process to have an insurance policy. And it is required throughout the life of that loan so that that asset is protected. And so that's one of the reasons why we always, want to make sure to have that conversation early so we can understand what you're protecting against and also to make sure that you're properly covered.
Okay, thank you.
Thanks, Jeffrey. I'll add that evidence of insurance is a requirement to get clear to close. That final mortgage contingency, you need evidence of insurance to clear a loan to close. And like Jeffrey mentioned, insurance is forward-looking. So you buy your policy for the next 12 months. You don't buy your policy for the last 12 months, right? So you pay that closing for the next 12 months. And it is so important to keep your insurance up that if your insurance policy lapses and your mortgage servicer finds out, you get what's called forced placement insurance. And it is one of those things that I think, if every home buyer had their say in it, would wish that we could disinvent, because forced placement insurance is not a good experience. It usually is 4 or 5 times your normal yearly premium, and you can't go backwards on it. So don't let your insurance policy lapse.
I think you
Anyway.
can advance. And
No, I think we're good here.
Okay.
Actually, these are the do's and don'ts
Yep.
on the mortgage side, and these are just something. These really don't need explanations, but I'm going to read them. First of all, on the do side, do continue to make all your monthly financial commitments. What does that mean? Pay at least the minimum on your credit cards, pay your car loan, pay everything on time. Why? It affects your credit. Okay, it affects your credit score. Do contact your mortgage consultant if your employment status will change prior to closing. So this is an easy one. If you're about to change jobs in the middle of a mortgage, that's very relevant. It could make your mortgage not financeable. So you need to let me know, and we'll talk about it. And sometimes it's a situation where you can change jobs the day after you close, especially if it's a good opportunity to increase your income. I've had that situation happen a couple of months ago, most recently, where somebody got a job opportunity to make more money in doing the same thing that they were doing. And they called and they asked, and I said, that's great. Don't do anything right now. And when we're done with the mortgage and you've closed, you can do whatever you want. And so sure enough, the day after she closed, she went and got her new job and made, however many thousands of dollars per year more. And she was really happy. Last thing, do contact your mortgage consultant if anything changes with your current income. Sort of same thing. Okay. Now on the don't side, don't authorize any increase into your credit. So this bullet point gets a little bit more consideration. You can have multiple lenders pull your credit, okay? And if it's within a certain period of time, it's not going to impact your credit score. So the system was never set up to where buyers who are shopping for, legitimate finance would be negatively affected, because for most people, a home is the biggest expense you'll ever have. So that deserves a little bit more insight. Don't incur any additional debts, including increases in credit card balances and co-signing for others. So don't co-sign for somebody, don't co-sign for a nephew on an apartment or a new car. Don't go buy a boat after you've had your credit pulled. A credit report, and when you do an application, you have a credit report. The credit report is a snapshot in time. It's not dynamically updated. So if you have a credit pull afterwards, and this really goes to the first bullet point, we get a notification that your credit was pulled after the credit report. Why? Because we have to make sure that you just didn't go buy a yacht and add $2,000 a month of extra debt that isn't currently on the report. That's why we're saying don't have your credit pulled after the fact. Okay? Don't close any open accounts. That also limits your credit score, makes it go down. Don't sign up for any credit repair or consolidation companies after application. True statement. Again, it'll mess with your credit. It's like dealing with a construction site. If the house is fine as it is and you want to make it better, fine. Do it after closing. Don't do it during the process. Okay? Don't spend money you have set aside for closing. Seems ridiculous, but don't spend the money you have set aside for closing, because we all are going to assume on the lending side that the money that you say is there for closing, it's still there. So your documents and your statements tell your story. You cannot tell us a story about how this great opportunity for this whatever came up, patio furniture, whatever, new car, whatever, and say that you spent the money on it and have it be okay. It may or may not be okay. And so if that is the case, just check with your lender first, because you don't want to damage a situation, because we're assuming that money's there. Okay, now you can advance the slide.
Yeah, sorry. And I think this is the two of you actually talking about, I think you talked a little bit about this already, but it's really the loan approval process and the next steps.
Right. So once we get the email from Jody that your loan has been approved and you're clear to close, then we go about scheduling your closing. We've done a lot of work before we get to the closing table, and that's really where we kind of get to sign the documents and celebrate the good fortune of being able to buy a home. And so, before the closing, I will receive the closing figures. I'll, help review them along with the other professionals in the transaction. I usually send them to my client, and then we attend the closing and we sit down, we sign a bunch of documents. Everyone says the same thing, that they're signing away their life, but they're actually doing a good thing. And so the closing process usually takes about 1 to 2 hours if everything goes well, and hopefully it does. Can take longer than that, and then you get your keys and you get to buy your home. And then Jody's going to talk a little bit about what the closing process looks like from a lending perspective.
I think you can,
Yeah. Yep, happy to. So yeah, just leave it on the slides. Sure. After the loan's clear to close, it's going to get scheduled. And once it's scheduled, and your attorney will reach out to you to ask you when is a good time on this date. There's going to be a closing date on your contract initially, so you would have already figured out what day you're going to close. If it needs to change to align with either the buyer or the seller's wishes or schedule, then that's totally fine. Usually happens during the week. You usually take a day off of work, or it's some time out of work to make sure that you're able to sign. You're going to get final figures from us as to what your cash to close is going to be. And I like to structure it so that number at the end is lower than the number at the beginning, okay? You're gonna get some credits at the end that we don't include in the beginning, because we don't want that number to creep upwards towards closing. No one likes hearing late in the transaction when you can't do anything about it, that your number is gonna go up. And so we do our best to structure situations so that you're getting a lower number than what you had in the beginning. At the beginning, we have to estimate all of the closing costs, call them 27 or 28 of them, that we don't know exactly what they are in the beginning. And that could be any number of things. There's only a couple things that we'll know for sure at the beginning as to how much it's going to cost, okay? So at the end, you're going to get this final closing disclosure. It's actually an official document. You can go online and download one to look at it. And that just allows everybody sort of a level playing field. We all have to use the same documents. Every lender's got to use the same document, okay? And that's just born out of a time in mortgage when everybody could use whatever document they wanted to, and they could be basically deceitful about it. And so it's the goal over the last couple of 10 years, let's say, has been to level the playing field so that everybody's got the same document with the same set of standards for each one. The last bullet point here is about wiring instructions. I have a severe allergy to wiring instructions. I will not provide them. Wire fraud is a real thing. It's why Christopher contributed to this slide. The best thing to do is reach out straight to the title company that you're closing at, get their wiring instructions from them if you're going to wire funds, and do it that way, and not through the attorney, or definitely not through me or your agent. So I can take this one as well. So closing costs, also known as settlement fees. So these are the ones that we are estimating upfront. Okay, we're estimating these things upfront. We don't know exactly what these are going to be, but we can estimate. You can estimate in Illinois that closing costs transactionally, meaning you're going to pay someone and you're not going to see that money back, is going to total probably $6,000 to $7,000. That doesn't mean that you're going to bring $6,000 to $7,000. It just means that that's what the closing costs are going to be. That's an estimate. That's everybody's estimated fees total, not just the loan. The loan has got a pretty simple, straightforward thing. You've got an interest rate, you've got a loan amount, you've got an origination fee, you've got prepaid mortgage interest, maybe, maybe not, depending on how we structure your loan and how you want it to be. But the biggest variable is what the title company is going to be charging. We don't know what that title fee is going to be because we don't know the title company up front and at all. So how can we know the fee if we don't know who's going to settle the transaction? But we lenders are tasked with estimating that fee. When it's all said and done, some things to take away. Your total closing costs are probably going to be $6,000 or $7,000. If you go back and do the math right now and you want to know about how much you would be bringing to the closing table on closing day, a good reasonable estimate is going to be, when it's all said and done, when credits are added, etc., it's going to be down payment plus $4,000 or $5,000. It's a very conservative estimate as to what you'd bring on closing day. If you want to have an estimate of how much you need, like how much do I need? So take an average purchase price, take your loan amount, and whatever the down payment is, let's say 3 to 5%, if you're a first-time home buyer, add $10,000 or so to the down payment number, and that's how much you need in total in order to buy the property at that purchase price. Okay?
Okay, we're almost done. So
Almost done.
last couple of slides, and instead of pause it now for questions, since I only have a couple more slides, just bear with me a little longer, and then we'll open it up for Q&A. So, so you're closing, and you have it scheduled already, and you got an email as to what time and where you need to show up to sign your life away. Before we do that, there is something called a final walkthrough. So that typically happens a day, no more than 2 days, and that's kind of stretching it. I really like to do it within 24 hours. Why? Because by then, the person selling the home has moved out, hopefully, or is almost done with their final boxes out of the property. And you want to walk it through with me to make sure that the house looks like it did when you made an offer, okay? It'll make sure that if there were any issues that you asked to be repaired as part of the attorney review process, that in fact, the things that the seller said that they were gonna fix, they're actually fixed. But unless otherwise agreed to, you're not gonna find the home sparking clean. That's another misconception that first-time buyers have. They think that somebody went in there and cleaned the windows in and out and got all the cobwebs. The only requirement is for the seller to empty the house and just broom sweep it clean. That's it. So it might not be to your highest cleaning standards, but that's really the only responsibility the seller has to you. as the buyer. If in that final walkthrough, we discover that something that should have been fixed is not fixed, or that somebody punched a hole in a wall, we stop all the presses. I pick up the phone, I call Christopher, and we work on a solution before we sit at the closing table. Anything you want to add to that, Christopher?
Just the importance of doing a walkthrough beforehand. And yeah, I mean,
For that
nothing-
reason.
For that reason, because
Can
things do pop up
Yeah.
at the last minute, and you want to make sure you're taking the property as you want it, and that it's empty, and that there's no furniture in there, and that the basement didn't flood and the roof's not leaking, and
Right.
major things like that.
Right.
So
Christopher, let me ask you a teed up question.
yes.
Let's say it's the final walkthrough. You're not there, of course, but you get a call, and the call is, hey, there was a painting up on the wall that is now not there, and there's a hole in the wall behind that painting that we didn't see before.
Right.
What's the process on closing day if that's the case?
Sure. So that's a great question. So the contract states that. So by the way, the contract we're referring to is called the 7.0, the multi-board residential real estate contract. I would say 95% of the time, particularly in Cook County, that is the contract that's used, and so it's the same for everyone. Within that contract, it says that the seller is responsible for making sure that the condition of the home is the same, as Laura said, as when the offer was submitted, except for minor wear and tear. So in that scenario where there was a hole in the wall, I would tell my client, look, so the hole in the wall, it's minor wear and tear, it's no big deal. On the other hand, sometimes something more serious comes up. Usually the situation is people leave behind stuff, we'll call it stuff. It's really junk, but it's stuff. It's someone's junk, it's someone's garbage in the garage or in the basement or in a crawl space or something like that. And that's a situation where we really try to get the seller or the seller's agent to get over there and get rid of the stuff as quickly as possible. Sometimes we have no choice and we have to come up with a monetary solution to it, and that always becomes very tricky for various reasons. But the point is that there are ways to negotiate these issues to make sure that the buyer's interests are being protected. But yeah, good question though.
He's making sure we're still awake.
Yeah.
Yes. Last slide. So also we dealt with any issues that may have come up at the final walkthrough. Nowadays, closing day with COVID, you might be in an actual table. You might be sitting in your car with somebody running out forms to you back and forth. It looks a little different in every title office, but let's call it the closing day table, whether it's an actual table or not, or you're in a Zoom. You have to make sure that you have a picture ID, and you have to make sure that the cashier's check was already sent to the lender. You have to be ready to have everything that Jody and Christopher and I tell you, and Jeffrey's insurance, the proof that the insurance policy is in effect. A lot of things happen before we're comfortable 100% that the closing will go through as planned. There's another mention here again about wire fraud. We always want to make sure that you have the right information. Wire fraud disclosure that I would make sure ahead of time that you've reviewed and signed. Hey, listen, we just want to get you your keys, and I want to be able to drop off a gift and surprise you with dinner that night. So this is supposed to be a happy day, and we want it to be without any last minute nasty surprises. So anything you want to add, any of you?
I don't think so. I think this is just another important opportunity to mention that it's important to have a team around you, and it really is important because you can't see necessarily everything that could possibly occur, and having a team is a good strategy to have. Let me give you an example. We had a closing a year ago in Cook County. It was a barely qualified mortgage. In other words, the buyers were stretching to buy what they could barely afford as it relates to mortgage qualification. So after clear to close, but before closing, Cook County released its second bill of the year. Their taxes went up, and all of a sudden they didn't qualify after clear to close. And in that instance, the way that we were able to navigate that was and this was on a weekend, I was able to navigate this with the team because I was able to call the insurance agent on Saturday and say, we need to adjust their coverage downward so that they still had enough coverage, but their monthly was less so that they could still qualify to close on Monday. That happened on a Saturday with a closing on Monday. So if I'm not able to call that insurance agent for that particular closing, we're scrambling on Monday, and scrambling is just for scrambled eggs and nothing else, right? So, so it really is important in those, in most of the time it's fine. Most of the time, most transactions are just fine. Little bump here, little bump there, that's it. Most of the time it's a ride in a Rolls Royce. It's fine. But it really is helpful to have a team in place if those unforeseen things occur. And that's it.
So I know we went a little fast. Sorry about the delay in the beginning again. We did schedule for an hour and a half just to be on the safe side. Obviously, this is being recorded like we stated. So if you feel like you need to drop off, you're going to get the link to the recording along with your home buyer guide, which is pretty much a PDF copy of this PowerPoint. You're going to get another couple things that highlight the products for insurance that Jeffrey talked about. But I do want to open it up for questions as we have time to answer them now if you want to stick around and ask us questions. And if you are the type that prefers to send us an email, we welcome that as well. You have all of our information on how to reach us, and we hope to stay in touch. But any questions that you have before we let you go for your Saturday?
Hi, can you guys hear me?
Yes.
All right. I had a question. You guys pointers things to do prior to final closing on a home. What would you guys say? What are the tendencies of when you guys have a smooth sailing? I think you call it Rolls Royce of a closing. What are the tendencies or things that couples that have a closing home do right? Was it for example, do they have the paperwork correctly? Do they have do pay attention to details, the small details, anything like that? Do you find anything common?
Yeah, you're asking. Yeah, I think you broke up a little bit on the question, but I think I heard you ask basically, what does the ideal buyer look like? What do they do to set themselves up for the greatest success? Does that sound about right?
Correct. That's essentially, yeah, that's what I was trying to ask.
Okay, gotcha. So here's what rockstar buyers do. First and foremost, I'll say it again, your documents tell the story. You don't tell the story. So a clean set of documents, individual saved electronic copies, PDFs that you have saved in a folder on your desktop, laptop, desktop, whatever, labeled mortgage. Picture it like a deck of cards that you can just deal from. You've got copies of your driver's licenses, unexpired, passports unexpired. You've got W-2s, individually saved, those income documents. You've got, if you need to, and you would know from the lender up front, your tax returns, all pages, all schedules, individually saved, okay? So 2020 tax returns, one PDF, 2021 tax returns, one PDF, etc. Everything that you could possibly deal with up front. Secondly, you've already carved a path to your pay stubs, meaning if you're in an industry, for example, did a loan with a postal worker could not get his pay stubs, but through this woman who he didn't even know the last name of the woman. He just knew that he called her, and a couple days later in the mail, his pay stubs would show up. Well, that's not good. Okay, and so we need to take out the machete and carve the path previous to the moment that you go under contract, because once you're under contract, it is monumentally stressful to do all these things after the fact. Okay.
Yep.
So having your documents set up correctly up front is super great. And then through the process after that point, sit on your hands. Don't make any loud noises. Don't make any sudden moves. Don't open a bank account. Don't transfer large amounts of money unless it was prearranged with your lender so that we know it's coming. Because if you transfer money, I'll give you an example. Someone who's under contract right now, didn't mention it at all before, didn't say they were going to get a gift. You can get a gift from family when you buy a place. It's pretty typical. 25% of all first-time home buyers get a gift from family. Typical. They didn't mention it at all. Then when they went to write an earnest money check up front, that's the money that you give to the seller saying, hey, we're serious about the offer that you just accepted here. Instead of writing a personal check, instead of transferring from their account, what they did is they got a cash gift from their mother. They went and got a cashier's check, and that's what they used for the earnest money. Well, that's a problem. We are tasked in lending to be able to source every dollar that comes into a transaction. If you have two accounts, account one, account two, and you're going to use account two, and that's what's on your mortgage application, but account one isn't there, and you transferred $20,000 from account one into account two, guess what? Account one is coming in because you have to source every dollar that comes in. We're responsible for keeping bad money, let's say, out of the U.S. housing economy. It's a place where people globally will funnel money and essentially clean it, launder it, so that it's in a different transaction. It goes from bad to good. So we're responsible for those things. So play along with that game, and be great clients and be collaborative, and then ultimately trust. I mean, you have a great deal of trust that you've got to have with the lender that you choose, the agent that you choose, the attorney that you choose, the insurance agent that you choose. And those are the people that have the best experiences, where the navigation of every little corner of the transaction is smooth, and you're able to trust the information that you got up front.
There was a
So
question
there's-
that came in. Oops, sorry.
I was just saying, there was a couple of questions and we
Yeah.
wanted to make sure we acknowledge those. One of them was about the
Home
housing
prices.
prices.
Yeah,
And whether or not they would go down as we saw 10 or 15 years ago.
right.
Can one of you guys speak to that,
That's
relative
you.
to relative to the trends that you're seeing?
Well, you remember one of the first few slides that we talked about in terms of prices increasing. We don't like to gamble like Vegas people do. And 10, 15 years from now, we don't know what's going to happen. Is there going to be another pandemic? Is there going to be another Lehman Brothers scandal? Like, we don't know. 10, 15 years is kind of too big of a forecast view for us here in this room, for anybody really in the world. They're not dropping in 2022. Not at the pace that we're going and the way that we're seeing. Will they drop ever? Perhaps. So I'm sorry if you're getting sort of like a very general answer, but we do like to see things in 12 months, maybe 24 months forecast. You guys have something to add? Yeah.
Sure. I think the question is directing back to the Black Swan moment.
Yep.
Back in 2007.
Yep.
So what's different about then versus now, and why I don't think you'll see that again?
Mm-hmm.
And I don't have a crystal ball, but I can tell you the data. I can tell you the facts.
Mm-hmm.
What was true about a bubble, and that's what you're asking.
Yep.
Is there a bubble?
Right.
Okay, so bubbles have very distinct characteristics. One of them is there's no supply and demand issue. There's no market-driven issue about prices rising. That's one thing. We do have a supply and demand issue today. So that's unlike 10 or 15 years ago. That's one thing.
Yep.
The second thing that every bubble has, whether it's housing, tech, anything else, is you've got fraud. Fraud is one of the best ways of predicting whether or not something is actually bubblicious. And if you go back to the tech bubble in the late 90s and you go back to like petrock.com or whatever that was that people were doing,
Yeah.
I would make an argument that if you wanted to look for a black swan today, I would say that non-fungible tokens, NFTs, are probably more indicative of a bubble someplace, not in housing though.
Right.
Housing has very strong market reasons for why prices have risen. I don't like that they've risen, and I don't think that they're going to drop that precipitously anytime soon, because the market is strongly suggesting that there's good market-driven reasons, market-based reasons for why they're increasing and why they probably wouldn't decrease that quickly.
That was a home run.
Oh, thanks.
Yeah. I will go ahead and answer the next question we have. Any fees involved when working with a broker? I'm assuming you mean real estate broker and lender, a mortgage broker. There are no fees, not for consulting, not for us to sit down with you, to spend an hour with you, to call us on a Saturdays. We get paid when we close. There are no fees involved at all. This is our job. If we are not passionate about it, we should not be in this industry.
Yeah, if you're working with a lender, it's important to know sort of the landscape.
A little different.
So,
Yeah.
so you don't pay anything up front to a lender. We don't have any upfront fees in order for somebody to apply, and most places don't. I would really strongly urge you to reconsider who you're using as a lender if they're trying to charge you for like an application fee up front. That wouldn't be typical for the industry. There's three types of lender in our market. There's the broker, that is buyer, meet, chase.
Mm-hmm.
And the broker takes in an application and probably processes it along with the documents and then puts it to Chase to underwrite. Okay, that's not me. But that is a type of lender in our marketplace. They tend to do well with people who have challenged credit and challenged income. They do really well. They provide a service to the market overall. There's reasons to go with a broker and there's reasons not to go with a broker. Keeping it simple, we won't get into those reasons, but that's category one of lender. Category two is the correspondent. So that's us, that's Fairway, that's Guaranteed Rate if you're a Sox fan. That's the middle ground. Those are the folks that own the entire process. We take in an application up front, stage one. We go to processing. That's our employee, stage two. Underwriting, stage three. Closing, stage four. Funding. All those things are in-house, but we're not going to keep your loan. We're going to sell the loan after the fact. It's going to get put in with a bunch of different other loans, and it's going to get put to a servicer. That's category two. Category three is the retail bank. You go in and you make that obvious sort of thought, which is like, well, they've got my bank accounts. I wonder if they'll give me a mortgage. I'll never forget the moment that I went in and did that, and I was still playing professional baseball at the time, but I was off contract because it was the off season. And my bank told me, we can't give you a loan. And I'm like, what are you talking about? and it was one of those things where it was like the lopsidedness of the mortgage I was looking for relative to the balances in the account. I'm like, what are you talking about? And they said, you don't have a job. Anyway, that's category three of lender, where you just walk into your place. So a typical mortgage is gonna have an origination fee. And if you're dealing with a broker, you're going to have an origination fee, a processing fee, an underwriting fee. Why? Because they don't employ those people. So they're going to pass through that fee to you as a broker. That's probably more information than what you needed, but that's the complete answer.
Yeah. Any other questions?
While we're waiting for questions, I will add on to that as well. There are no fees involved from an insurance perspective until you decide to buy a product.
Mm-hmm.
So we're happy to, if you guys have questions about, this is a house that we're looking at, can you give me a rough idea of what the insurance cost would be? That is a free service that we also provide. And I think that's one of the things that, people have to think about when they're buying. To the example that was given earlier, can I afford the house in total? Not just can I afford the mortgage, but the other aspects of it. How much is my insurance going to be? It's probably a good idea for you to think about things like, what's the typical water bill look like in this place? What's the typical, electric bill look like? Gas bill. Those are things that you also should consider as you're considering this process. But it is which is a point that we brought up earlier, it is one of the most stressful moments in your life, but it's also a great moment that you can turn it into an opportunity for you and your family to make that next leap from an economic perspective. And also you have an asset that you can pass on to your family.
Thank you.
I think we're good.
I think we got a thanks for lots of info. Yep, you're gonna get the recording. Sometimes Zoom takes a few hours to download the recording file. So instead of bombarding you with separate emails, perhaps tomorrow or Monday, it's when you get the final email with the guide. We have your emails. We're not gonna forget about you. Don't forget about us. You get a packet. You'll get any other attachments, additional information, as well as a link to the recording. So thanks for joining us today.
Thank you.
Thanks, guys.
Bye.